Hey, soldiers, we've just witnessed the second biggest bank failure in U.S. history happening now. And in addition to that, there is another very, very large, reputable, big name institution that is having a lot of difficulties. If you've got your money in there, you might want to reconsider and make some moves, because when a bank run happens, bank run is exactly what it sounds like. People lose confidence in the institution. They run to the bank to get their money out. When that happens, you don't want to be the last person in line, okay? You don't want to be left without a chair once the music stops. Now, one of the reasons why that might happen is because, banks only have so much money actually on hand. They're lending this money out, making it work. But here in America, we do have a very important backstop that has actually come to the rescue in the case of Silicon Valley Bank. This is the first bank we're going to talk about. If you've got money on deposit there, you better listen up, because this is important. And again, it might be a canary in the coal mine with regard to the financial services sector, especially that banking subset as a whole. Silicon Valley Bank collapsed Friday in the second biggest bank failure in U.S. history after a run on deposits doomed the tech-focused lenders' plans to raise fresh capital. Now, this other bank we're going to talk about, they're out there trying to raise fresh capital, and it ain't going too well. So we're seeing the same type of symptoms occur with both types of institutions, the smaller Silicon Valley Bank and the larger bank that we'll get into in just a minute. The Federal Deposit Insurance Corporation said it has taken control of the bank via a new entity it created called the Deposit Insurance National Bank of Santa Clara. All of the bank's deposits have been transferred to the new bank, the regulator said. Now, I want to focus on that. Said all of the bank's deposits, so whatever they had, doesn't necessarily mean that, the $1,000 that you had in there has been transferred. It just means that whatever they had on hand has been transferred. So if they loaned out $500 of your $1,000, then that has been transferred over. But remember, we're dealing with the Federal Deposit Insurance Company, which does insure your deposits with U.S. banks that are with the FDIC, and I can't think of any that aren't, up to $250,000. Now, to the extent someone had more than that in this institution, they could be looking at losing that. Insured depositors will have access to their funds by Monday morning. So they're not going to have their money today, tomorrow, Saturday the 11th of March, or Sunday the 12th of March. They've got to wait until Monday. And waiting on your money is better than, I guess, not receiving any at all. And this is according to the FDIC. They're saying you got to wait until Monday. They just set up this institution. They're going to, start to unravel this as far as your money on Monday. Depositors with funds exceeding insurance caps will get receivership certificates for their uninsured balances. So see, that's a risk that you take when you have money on deposit in one institution, and that amount is over and above the FDIC insured amount, which is right now is $250,000. Once a darling of the banking business, SVB, or Silicon Valley Bank, collapsed at warp speed after it announced a big loss on its bond holdings and plans to shore up its balance sheet, tanking its stock and sparking widespread customer withdrawals. All right, and right now the stock has been halted. It's not trading right now because of, for obvious reasons, right? The bank's parent company, SVB Financial Group, was racing to find a buyer after scrapping a planned $2.25 billion share sale Friday morning. It is Friday morning, the 10th of March. So they were going to do that this morning, but regulators were not willing to wait. They moved in. Of course, your share sale is going to be scrapped if the federal government is coming in and saying, nope, we're taking control. The California Department of Financial Protection and Innovation closed the bank Friday within hours and put it under the control of the FDIC. So you want to talk about something that's the exact opposite of a confidence builder. If you've got the federal government and the state government coming in, closing you down, you're not selling. There's no confidence there, right? SVB, based in Santa Clara, California, earlier this week surprised investors by announcing that it lost nearly $2 billion selling assets following a larger than expected decline in deposits. I want to take a moment right here to thank one of the soldiers, Marion, for doing some reconnaissance and early this morning alerting me to what was going on with this, because this is a very important story. So thank you, Marion. The soldiers are out there keeping their eyes open, keeping the reconnaissance up so that we can bring you this type of very important financial news. The stock has lost more than 80% since then. So let's just go over that again. The SVB earlier this week, this is when they told the investors that it lost $2 billion. And since then, the stock naturally has lost a lot of money. In this case, 80%. You announce something like, oh, you lost $2 billion? And lost meaning it came off the balance sheet. They're just not doing good in this higher interest rate environment. Tech clients, which is their forte, rushed to pull the deposits over concerns about the bank's health. So you had a bank run from these tech clients. And of course, you see something like this is going to call into question the health of the industry, because as I said in the beginning, you don't know if this is a canary in the coal mine event. The four largest U.S. banks lost $52 billion in market value on Thursday, the 9th of March, 2023. And a broader index of bank stocks had its worst day in nearly 3 years. Bank stocks continue to plunge Friday morning with the number halted for volatility. And let's just get into some of the names that were halted real quick. Because of that, we got First Republic Bank, Signature Bank, PacWest Bancorp, and Western Alliance. Okay, bankers at Goldman Sachs had arranged for that share sale at $95 a piece on Thursday afternoon. People who are familiar with the offering confirmed that as they kept seeing SVB shares tumble and people pulling their money out of the bank, the whole deal for the share sale, of course, fell apart. On Friday morning, the bank told employees to work from home today and until further notice. That's got to be scary. If you're an employee of the bank and you're reading this news, you're watching the Soldiers of Finance channel, subscribe, please. You've got to be thinking, whoa, we're going into the weekend. It's kind of, the weekend still is kind of a period of a news blackout from a lot of quarters, especially banking, okay? So it's going to be a nervous weekend for a lot of their employees. It's unfortunate, okay? These are people that are working and trying to make a living and trying to do the right thing, and the bank just wasn't able to withstand the current financial conditions, apparently. Now, all of this is as a result, mainly, of what's going on in the tech sector, which we have been following. This bank, SVB, catered mainly to startups and the investors that funded them. This is an insular ecosystem that has taken a big hit since the Fed began raising rates last year to curb inflation. This is the tech sector. Startups, as a result, drained their deposits with SVB faster than the bank expected. Because look, even the large tech companies are facing layoffs, lower revenues. So these small fries are trying to get their hands on cash to stay in operation, and that sapped the strength of SVB. Startups drained the money out of the bank, and new investments stalled, of course, because you don't have as many tech startups right now coming into the arena because of the environment. So the fresh money was not coming into the bank. Meanwhile, rising interest rates dented the value of SVB's holding. The bank late Wednesday disclosed it had sold a big chunk of those holdings at a loss. Investors dumped the stock, spooking customers and sparking a bank run. Chief Executive Greg Becker held a call with jittery customers Thursday, telling them the bank was on solid financial footing despite the loss, but concerned SVB clients were already calling rival banks looking to move large balances in excess of FDIC insurance caps. Now, you're going to find that probably most of these clients of SVB exceeded the insurance caps because they are businesses and well-heeled venture capitalists, okay? So it's going to be easy to exceed that limit. Where do you put your money if you are facing these limits? Maybe you spread it out amongst banks or put it into different types of products, like, again, insurance products that can maintain the value but diversify you away from these caps. So probably a lot of these guys had that type of thing going on. Now, not to be outdone, we've got Credit Suisse, which is a much larger institution. Their shares hit an all-time low as a result of SVB, but also as a result of some issues that they were facing even before this news about SVB came to the fore. Credit Suisse had postponed publication of its annual report after a last-minute call from the United States Securities and Exchange Commission, which raised questions about the company's earlier financial statements. Listen, pausing your annual report is a great big deal for a public company, all right? Because those quarterly and that annual report, those give you, that's the pulse of the business. They give you, the hardcore numbers you can find in those publications. So they've been ordered to hold off because, well, they've decided to hold off because they got this call from the SEC questioning some of the data in their earlier financial statements. The unusual intervention by the U.S. regulator is the latest blow to Credit Suisse as it attempts to rebuild investor confidence after a series of scandals and setbacks that have sent its shares plunging and led clients to withdraw billions. We did the report the other day where we talked about the fact that they're trying to incentivize people to come back and put money into the bank by giving them a much higher than market rate interest rate. But I don't think that that's going to work, especially after you're seeing what's happening with SVB. Who's going to risk putting a lot of money into a bank that is admittedly having problems and now also is being questioned by the SEC? Credit Suisse's shares were close to their all-time low in Zurich on Thursday, but later recovered much of a 6% loss. So it's flirting with the lows there historically for that company. The Zurich-based bank said the SEC had called it late on Wednesday regarding certain open SEC comments about the technical assessment of previously disclosed revisions to consolidated cash flow statement in the years ending December 31st, 2020 and 2019. So all you got to do is ask yourself, A, would you put money in Credit Suisse right now? And B, would you buy Credit Suisse shares right now? You can't do your due diligence. You know how I always say do your due diligence? You really can't right now. Not until they sort out these questions that the SEC is asking them, right? And not until they issue that latest annual report. So that's what's going on in the banking sector, guys. Now, fortunately, these two banks really don't hit the consumer sector that hard. But again, if banks that cater to these well-heeled businesses like venture capitalists and well-financed Silicon Valley companies, if that's the case, then you gotta ask yourself, what's going on at my bank? Do you bank with one of the big boys, or are you at a small regional bank? Might help to break open their annual report or their latest quarterly report and start to delve through that thing and try to find out what the deal is. Maybe have a conversation with the bank manager. This is your money we're talking about, right? All right, guys, go ahead and hit that thumbs up, subscribe, send this to a loved one or a friend, because again, this is about money on deposit that many of us can't afford to lose any of. All right, now I want you to check out this report we just did the other day. You got to be careful where you invest your money. Kevin O'Leary is out there being very explicit, saying if you put your money here or here, 9 times out of 10, it's not going to be pretty. Watch the report, guys. I'll talk to you soon.